Many of you are probably aware of the UPS Airlines Flight 2976 that crashed on takeoff coming out of Louisville, Kentucky as it was bound for Honolulu, Hawaii. I was rather curious about whether that would have any important implications for some of the companies involved, and we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where I take your questions and we try to work through some investment-related questions that we might have together. Over the course of the weekend, I spent a little bit of time looking at the crash that took place back on the 4th, when a UPS MD-11F, the F stands for freighter, crashed on takeoff, leaving Louisville, Kentucky, headed to Honolulu. As I was curious about, first of all, just about the nature of the accident itself. I have a little bit of an interest in aviation accidents. I'm not a pilot, but it is something that I have an interest in. Not a morbid curiosity, but just something that, just on a personal note, people in the family who are interested in aviation, and people in the family who were aviators, and one of which, my grandfather, who was killed piloting a plane himself. So I've always sort of followed this with some interest. Now, the plane that crashed, an MD-11F, MD for McDonnell Douglas, this was a plane that is a more recent variant of a plane that was formerly known as the DC-10. It's a tri-jet, three-engine, wide-body jet. The DC-10 had its own rather controversial operating history. The plane, when you hear about the manufacturer, you're going to hear the name Boeing bandied about, and the reason is because of the merger between McDonnell Douglas, for which the MD and MD-11 comes from, and Boeing. The plane was powered by General Electric CF6 engines. The CF6 engines don't just power MD-11s, they are also used in other applications, including on 767s. That becomes a little bit relevant here, because in this incident, and some of you are going to be aware, and I'm not going to recount it because there are a lot of people who have far more expertise than I do on this who will be able to share insights, but you'll be able to confirm with those sites individually. Among those that other YouTubers, for example, that I think cover this type of thing very effectively and well and in language that we can all probably understand, include the Blanco Lirio channel. The guy who runs that is Juan Brown. He's a commercial airline pilot, former Air Force, I believe. Captain Steve is another one. He's a recently retired commercial airline pilot, also, I believe, a former military pilot as well. So, as I was, watching those channels and video footage of what was going on, I was curious to see whether there would be any implications for some of these companies involved. Obviously, UPS is involved. Boeing is clearly involved. The engines were manufactured by General Electric. They are involved. General Electric engines have components that are made by other aerospace companies, including Howmet, Safran, and MTU. So those companies all could potentially have some involvement. The NTSB, the National Transportation Safety Board, has given several press conferences on this, and they have recovered the CVRs, the cockpit and data voice recorders, both, and they've had an opportunity to review some of that. Now, the part that's relevant here, and what actually got me looking at one of these companies in particular, the plane was taxiing, was fully loaded, and so it was going to be a long takeoff run. On or about the time that the plane, or maybe just after, the plane reached V1, which is the decision takeoff speed. Once a plane that is taxiing down the runway gets to that speed, the determination to fly has been made affirmatively at that point. In other words, you hit V1 and you can no longer reject the takeoff. There's not enough runway left to do so. If you listen to the cockpit voice recorder, well, I haven't listened to it, but I've listened to I think what's a mock transcript of it, a bell goes off 37 minutes into the takeoff roll after they called for takeoff thrust. And that bell chimes, and then you can hear engine 1 fire, or fire engine 1. And that indicated the trouble that they had with the left engine that actually departed the aircraft very shortly thereafter. That means that it actually ripped off the wing, along with the pylon. The pylon is the part that holds the engine to the wing. When a DC-10 crashed in Chicago many years ago, this happened to that plane. There's a pretty horrifying picture of that accident. That was due to some issues with the way that plane was maintained. But the short version in all of this is that the pylon is actually engineered to, in a very stressful circumstance, to depart the wing. And the reason for that is that if there was something dramatically wrong that would otherwise harm the airframe, you want where the pylon mounts to the wing to be a potential weak point so that it could depart. But unfortunately, as it did so, it looks like debris that came off of the departing engine may have been introduced into one of the 2 remaining engines. The MD-11 can fly on 2 engines if they're functional, but if debris is introduced, they can experience issues such as a compressor stall, and it appears that this is what happened. So it got me thinking that if you think about the order of events, is it possible then that the problem was initiated with engine number 1, the engine that was underneath the left wing of the aircraft, and it seems likely or probable. That's where the fire was. That's the engine that departed the aircraft. And there have been prior circumstances where they've had rotor disc failures on engines of this type. And, other things, of course, could have caused it. You could lose one of the turbine blades. There's a lot of things that could have happened. It's not terribly important because, again, I'm not an expert on these. But the important point for me was, is that where the problem originated? And it seems from the press conferences that the NTSB is holding that this is something that they're examining very, very closely. Now, just because, even if that was true, that's where the problem originated, doesn't necessarily mean it's the fault of GE or Howmet or Safran or MTU or any of the manufacturers that are associated with any of the respective components. We don't know what happened. Was there a maintenance issue? Did something else get introduced into the engine as they were taxiing down the runway? But the reason it's relevant for our conversation is because it did get me looking at GE. So ticker GE is GE Aerospace. I have it up on my screen right now. When we thought about GE in the past, ticker symbol GE was really the conglomerate. And GE, the conglomerate, had GE Finance, they had GE Aerospace, they had their locomotive business, all of these different things. They owned NBC, actually, at one point, which in turn owned CNBC. First time I went on the air at CNBC, it was actually a subsidiary of General Electric at that time. They have spun off some of their businesses. GE now refers to GE Aerospace. And the observation that I made when I started to look at this, as I was just kind of going through the list of different companies, is that this is a company whose stock has performed remarkably well. GE Vernova, by the way, is another portion of the former General Electric conglomerate's business related to power, which is of a lot of interest to people now as well. But it's pretty clear that this stock has really done exceptionally well. I mean, it's something like a 9-bagger at this point since 2022. It's up over 90%, I believe, year to date. We can actually confirm that. Let's just take a look at its performance year to date, and as of today's close, oh no, not quite. I must have been looking at it from a different period. Year to date, 87%. Not too shabby, I think we can safely say. The other thing that sort of caught my interest, though, when I was looking at it was the company's valuation. So this will be a familiar screen to those of you who tune into the channel fairly often. That I like to look at this as just sort of a high-level synopsis. So we're not looking at the balance sheet necessarily. We're not looking at the income statement. This is sort of a consolidated, highlights to look at in the financial statements. And what we see here is that at this point, the company is now trading at quite a heady valuation, right? So we can see that the full year estimated adjusted earnings per share is about $6.23 a share. This is for a stock that's trading for $312. Growing at a respectable rate, to be sure. Not anticipated to grow quite as quickly next year. $7. But still, that kind of caught my eye because as I looked at that, I thought, wow, I mean, that's richer than NVIDIA. And not a little bit richer. It's kind of a lot richer, right? So we're going to pull these two up side by side so we can kind of just think about that for a moment. So NVIDIA is anticipated to do $6.65 a share, which next year, which is in the same order of magnitude, if you will. So if we take a look at that, that's $199. So we're just looking at next year's earnings. That gets us to just under 30 times earnings. General Electric, and actually I should just say GE Aerospace because I kind of feel like that's more representative. This one's trading at 43.8. 43.8 times earnings. I thought, well, that's interesting. Pretty rich valuation there. And then I was looking a little further back and thought, okay, well, what's the expectation from the street in the forward years then? I mean, how fast do they expect this thing to grow? I mean, its growth rate is not that of NVIDIA. Is there something really extraordinary expected to happen? These are very respectable growth rates. You know, what is the benchmark that I'm looking for? Something that grows faster than the S&P, and it looks like it is expected to accomplish this, better than 6% top-line growth. And as we can see here, maybe this year is going to be 35%, but in the coming years, 14, 17.6, 10.5%. These are very respectable numbers. But would I rather be in a company like this, trading at 43 times earnings, that's going to be growing in the teens, rather than a company that's trading 12 turns cheaper, that's growing faster? In fairness, we could say maybe the AI data center GPU business isn't as stable, doesn't have the longevity, the stability perhaps, that a jet engine manufacturer might. But it did seem, it was enough to sort of open my eyes, if you will. And then something else stuck out, and that was this. Right here. I'm going to underline it. So the street's expectation, these numbers, this $9.25 per share, is predicated on the street's expectation that the company's adjusted net income margin is going to expand to 17.4%. That's after taxes. And I thought, well, that sounds very good for an industrial, and I imagine we have Pratt & Whitney, we have Rolls-Royce, we have a couple other companies that compete. And this, by the way, I mean, it's not like it's their only business is making CF6 engines, but it did occur to me that, okay, maybe there's not a huge amount of competition. There's a handful of potential competitors. Pratt & Whitney has a geared turbofan engine, which apparently had some challenges, and apparently that was sort of beneficial for GE's business as some customers decided to go with GE engines rather than the Pratts. But I just decided I would take a look back and say, okay, well, and realize that some of this is probably a little bit of pro forma mixed in here, because remember, we're going back now in time to pre-corporate action dates, right? So, like I said, General Electric has restructured some of their business over the course of time, but I was very curious, the way these statements read, how common was it to get net income margins in this business that exceeded 15% after tax? Because that just seemed like a lot for an industrial to me. And so I went back, and I kept going back. And the short answer is I never found anything like that. In fact, the margins that the company has experienced over the last 12 months are about as good as anything I could find in the history. And so what that says to me is that the company is trading at a richer multiple than it has historically. We can take a look here and just say, okay, well, what's the 5-year average multiple for this thing? And where does this one compare? So when the blue dots that we're seeing up here are to the right, as you look at your screen of the orange dots, that's saying that it's trading at a richer multiple on a price to forward earnings, on a forward EBITDA to current enterprise value, EBIT to EV. On any of these things, the stock is currently trading at a higher than average multiple, a fairly generous multiple relative to its peers as well. I don't know that these are all perfect peers. I don't know that I would necessarily think of these companies as being perfect peers, but definitely was getting up there. And then in the midst of all of that, there is this overhang. Is it a material overhang? Well, I don't know how great the liability would be for General Electric if anything does end up pointing in that company's direction. Again, I want to make it amply clear that's not what I believe or know. I don't really know or believe anything at this point until the NTSB comes back with some concrete reasons for this crash. They'll have a preliminary report usually within the first 30 days, but unfortunately we're not going to get real answers until much longer because we're probably looking at 18 to 24 months before the final reports are issued. Still, it did occur to me that it could present a little bit of a cloud over the head of some of the associated businesses. And if you already had a business that was trading at a valuation much greater than it historically enjoys, and if the street is already looking for operating performance, particularly margins, that are much broader than the company has ever experienced, and the stock is already up 90% so far year to date, it just began to occur to me that it feels stretched. As Carter Worth would sometimes say, it's full, fully priced. And so with that in mind, my thinking is that if you own the stock, you might consider selling some covered calls or something like that against it. None of the things that I've just discussed seem to have had any impact whatsoever on options prices, not meaningful ones anyway. If you take a look right here, I'm going to get rid of the historical volatility chart, and I'm just going to shorten this up so we're only really looking at it since they reported earnings, because most of the relevant companies, whether it's UPS or Boeing or GE, all of these companies have reported relatively recently. But let's just take a look. Let's see, can I go to 1 month? We'll see what this is. Okay, so now we're just looking at the charts. Oh, no, I didn't want monthly. I wanted daily, but I wanted it for 1 month. That's what I wanted. We'll just do daily 3 months. Here we go. So this bump that we see here is a bump that's related to earnings. And this is the price of options now. And to the extent that there was an impact as a result of the accident, I don't think there is really an observable one. It seems to have waned somewhat since. So my own thinking, if you have been fortunate enough to own these shares all of this time, I have not myself. Wish I had. You may want to think about writing some calls or some call spreads. I was looking out to 1 and 2 month call spreads, ones that expire before the next time that they report earnings, things that where you might be able to call it 40% of the distance between the strikes. So maybe a $10 or a $20, you could get $8 for a $20 upside call spread. That might be something to take a look at. And for the more ambitious who are wondering whether, either for reasons of beta or reasons of valuation, or maybe that the news narrative on all of this doesn't turn in their favor, you could also consider selling upside call spreads to buy potentially downside put spreads. Something we talked a little bit about last week with respect to SPY. Okay, so I think, did I see here? Oh yeah, FinWest made a comment. The number 2 engine had a compressor stall, apparently, so it didn't have 2 operating engines. Yeah, that's right. It appeared to. The compressor stall characteristic that they were referring to was that if you see the video of the plane, so it's in a nose high attitude at the tail end of the runway, and you can see these brief puffs of flame coming out of what looks to me to be the center engine, which would be indicative of a compressor stall, in which case the engine would have been delivering much less than its full power, maybe not much meaningful at all. And I'm not sure that from that viewpoint one can really see what's going on with the engine underneath the right wing. So it could be, yeah. Oops, 1 second here. Yeah, so I see Matt McDonald saying, weird that the plane couldn't continue to fly on 2 engines. And unless the lost one caused massive hydraulic failure in the wing and throughout. So that's an interesting observation that you're making, Matt. And the reason it's an interesting observation is because in the crash involving the DC-10, where the left engine number 1 departed that aircraft, also similarly where most of the pylon structure did, what happened in that instance, as I understand it, and like I said, I'm a little bit of an aviation buff, and so I studied this somewhat. When the first engine number 1 on that DC-10 ripped off, it severed hydraulic lines that ran to that wing. And the plane, which had only just taken off, was basically it was configured as such. So that meant that the slats and the flaps were extended. The slats are the part, if you've ever ridden in a commercial airliner and you've looked out the window and you noticed that the shape of the wing was changing as the plane slowed down to land, or as they, before they took off, the slats are the part of the wing in the front that extend outwards, and the flaps are the ones in the back. As that DC-10 was losing hydraulic pressure, the air resistance pushed the slats on the leading edge of the left wing of that plane backwards, which of course increased the stall speed for the wing. And that was the reason why that plane rolled to the left. In this case, that also happened, although it's less clear that there's a couple things. One is that they made some changes mechanically to these planes so that in that event that wouldn't happen. But if the plane didn't have enough thrust, then it was going to stall into the wing that had less lift in any case. And it does look like maybe that's what happened here. But those planes can fly on 2 engines. They can not only fly if they were fully functional on just 2 engines, but they can climb on 2 engines. So, a 737, which is one of the most common commercial single-aisle aircraft in the world, almost everybody I'm sure watching has flown on one of those. That is another plane that fully loaded can climb on a single engine. And I only bring this up because actually there was a 737 that departed Burbank recently that had an engine out and ended up making an emergency landing on one of the northern runways at LAX shortly thereafter. I think it was like 20 minutes later. So these planes should be able to climb if everything else is working. But it is clear that there was a lot going wrong, and they had very little time to react. It would seem that whatever happened arguably at the worst possible time. Immediately after V1. That's just horrifying. So let's see here. Matt McDonald, as a pilot, I find this weird and concerning. FAA has since today grounded this type for what seems to be obvious reasons. So this is an interesting observation as well, right? So the grounding of the MD-11s, let's talk about that for a second, because I didn't really talk about Boeing. Boeing apparently asked. FedEx and UPS probably would have grounded these planes voluntarily in any case. Boeing asked for it. So that flight directive what often will happen is if an issue is identified, they will ground the fleet with an airworthiness directive. And that airworthiness directive, if the problem is known, will direct those affected to have a remedy to get the planes back in the air. That's, of course, not the case here because the exact cause isn't known yet. But again, I think from our perspective, and you can look at some of these other companies too, right? I looked at Safran, so that I looked at MTU, and Howmet is actually a pretty high flyer. But some of these other companies are not. They didn't stick out from a valuation perspective quite as much as GE did. In Boeing's case, obviously the company has taken on, they've had a lot of problems, and the one other quick point I would make is that the MD-11 was an older airplane. I don't remember exactly when that one was manufactured, but I think it was like 28 years old, that plane. And the other thing we should probably bear in mind too is that it's not like these companies face unlimited liability. It's not like they should face unlimited liability. Also, it just was just something that I was looking at and trying to see. Okay, what companies are involved, and one thing led to another, and I looked at GE Aerospace and I thought, wow, that thing has really moved a lot, and its valuation is a little rich, and they have some involvement. So you put all of those things together, and that would be a bit of a compounding thing. Now, one of the other things, this is Tucker D. Dog says, how much will this impact FedEx and UPS operations? So I believe that the number of MD-11, the affected aircraft, is in the high single digits for both carriers, which is actually less than I expected because I have seen these planes around quite a lot. I used to fly cross country back and forth every single week for a decade, so I have spent a considerable amount of time in airports and seen a lot of these MD-11F freighters, and I was always fascinated by that. I thought, why are they using those? And I looked into it. I mean, they're big planes. They were popular for a brief period of time for passenger travel, but they're used for freight almost exclusively now. So I was surprised to see, given how often I would see those planes, but maybe they just stuck out in my mind whenever I saw them because they're distinctive, right? Most other planes are two-engine designs these days, with a rare four-engine design. The tri-jets are unusual. So you see a wide body with an engine in the vertical, and you say, okay, well, it stands out a bit. So maybe you notice them more often. That is part of it. Now, it's interesting, too, because this was happening at a very ticklish time of year for these carriers. The holiday season is one where you have more stuff being shipped in general. UPS has struggled with this. Now, logistics, interestingly, I think, so Tucker is saying 4% of FedEx fleet, 9% of UPS. I, for whatever reason, in my head had 7 and 9. So high single digits was the numbers that I had. But so even smaller for FedEx. I've seen a lot or I thought I saw a lot of FedEx MD-11s from time to time. Interestingly, though, a lot of the operational challenges that UPS and FedEx have faced at this time of year have been on the ground. I'm sure many of you are familiar with some of those stories, but with respect to trucks and so on, and the drivers getting overwhelmed, people pulling the truck up to the woods and just throwing all the packages out because they couldn't take it anymore. Hopefully they don't do that anymore, but I thought that was all kind of interesting. So we don't have to get too bogged down in it, but it's probably clear to you at this point. It was something I was thinking about, and I thought I would share it with you all. So let's take a look at some of the other questions that we have. Jim Howard says, can you take a look at FI and thoughts on a possible trade, wondering if it has bottomed? This is an interesting case. Now, this seems like a potential setup for the Carter Worth trade. Carter loves to sell strangles on stocks where new information has, sort of become publicly available, like on an earnings. So you get an earnings miss, or an unhappy sales report, or maybe even a good one, so the stock could go lower or it could go higher, and you get the stock gapping sharply in one direction or another as the market digests the new information. And his thinking is that when that happens, there's a degree of efficiency in the market's ability to find a new price level, and one that will probably persist for a little while until additional information is learned, which could be on a subsequent sales guidance or a subsequent earnings report. So the short version is, could it have bottomed? It may have. Do I think this would be probably a more interesting time to make the bet that we're going to be range bound? I would argue potentially yes, because you've had this profound move. Volatility, implied volatility, the price of options will typically decline precipitously after an event takes place, and it has declined here by a good amount, but it still remains highly elevated. And this makes some sense to us because there is a lot of uncertainty, and there are a lot of people like you, Jim, who are asking themselves this very question. I was actually on a call earlier today with Carter as we just talked about the intuition of why it is that options prices might be unnaturally elevated following an event when most of the meaningful information was just revealed. And the answer is easy enough to understand when you think about how people like you are looking at this, which is, well, if the stock was 50% higher than it is right now, couldn't it return there? Well, it certainly could. There are people who owned the shares that are hoping that it will. There are people that bailed out on the shares because they can't stomach any more losses, but are going to buy calls just so that they don't get whipsawed and beaten up both ways. I mean, what could be more painful than owning the shares, having them decline by more than 40%, selling them, unwilling to take additional loss, only to see the shares rebound? So that's a natural buyer of upside calls who just wants to get some participation in the event that the stock rebounds. What about the opposite case, where somebody owns these shares and the stock has declined by more than 40%, and they don't want to sell them, but they also don't want to take more pain? So that investor might be inclined to buy themselves a little bit of incremental protection, saying, okay, I can't take much more of this. I don't want to sell, but I can't take much more of this. So that will tend to elevate options premiums. How elevated are they? Well, let's just expand this to 2 years and draw a line. So they're not as high as they were. And the interesting thing is, one of the things you can see here is that actually the second day, you still could have sold about 60 implied vol in these things. This is 1 month options. Let's take a look at the 2-month options. Similar situation. You could have sold 2-month options the day following the gap at 58 vol. What does that translate to? So they're much lower now, but they are still, I mean, looking at this chart, I think we can safely say that options premiums remain highly elevated. Should they be? Well, I would actually suggest that now that we're several days into this, the market has basically told us that this thing has found a new level. Barring some new information, which is not on the immediate horizon, this is where investors have essentially established what they think is the intermediate fair value. So my thinking would be, before making a bet in either direction, if I was going to make a bet in either direction based on the premium charts I just showed, it would absolutely be something like a call spread risk reversal if I was making a bullish bet. I might do something like a 1/2 put spread if I was making a bearish bet, but I'd otherwise be more inclined just to sell a strangle. I expect that that's probably going to be the trade that's almost certain to make profits. But let's take a look at each of these so we can kind of compare them. So let's start first with the bearish 1/2 put spread that I was just talking about. So what do I mean by that? I'm going to get rid of the stock. it doesn't really matter what expiration I'm going to take a look at. Maybe I would look at something like the 60 puts, and then I want to sell a couple lower strike puts against it to get some downside participation. Let's see here. This one's not very good. Here we are. To lower the cost, I can go for down a little more. So that's going to look a little something like this, right? So basically not laying out any premium, and I end up with a downside break even that's, down here around $52. So the stock's going to have to give back, at least another 15% before I actually end up taking any losses to the downside. But that's really just a play on intermediate weakness. And you'll notice something, that if you go further out in time, what you're going to find is that you can now select options that are farther apart. So this one also, 1x2 is going to cost basically nothing. Stock has to go down to $50, down $13.50, or close to $14 from here, before you actually have the risk of having the stock put to you. If I was bullish, which it sounds like you might be more inclined to be making a bullish bet on it here, something like a call spread risk reversal, again, because I just don't want to be net long too much premium, because I think the premium is overpriced. So here I might look to sell a downside put to finance the purchase of an upside call spread, and I could end up with something that looks a bit like that. But the trade that I think is most likely to be profitable, and the one that makes the most intuitive sense to me, is the Carter Worth You've Been Strangled. And I'm just going to go to the Dees regulars for this exercise. And, so you're going to be selling a call, selling a put, and doing something that looks... Oops, I didn't switch it. There we are. You're going to be doing something that looks perhaps a bit like this. I have a tendency, as you guys probably know, to sort of tend to favor, give myself a little bit more of a buffer in these cases most of the time for the upside. I'm just more comfortable with the risk of being put a stock at a discount. If I'm going to put a trade like this on, then I'm interested in potentially getting called out on the short side. But here you have a trade that's going to pay a little over $3 in just over a month on a $63.80 stock. So we're looking at about 4.8, 4.9% returns in about 5 weeks or so. Not a bad annualized rate of return, and the risk is that you end up getting short the stock at that $75 strike price. So 75 is considerably higher, plus the $3.10 in premium you collected. So you could be short this stock at $78.10 to the upside, or alternatively, you might be put the stock at 60 less that, which is going to be $56.90 a share. So this is the way I would do it. I don't happen to be looking at this one, partially because I'm not sure I really gather what it is that's just going so very wrong with. Despite this, you can see that I still would skew it to the upside somewhat, but that's probably the options trade. Well, now let's take a look at the. Normally we start the other way, right? We don't need to look at the chart. We saw the chart. It's a disaster. It's now consecutive gaps lower on results. I think now you can probably see why this isn't normally something that shows up on my radar, because it just sort of, there's a lot of optionable securities out there. This one doesn't quite meet my my own personal litmus test, which is that if I'm going to start taking idiosyncratic risks, show me some idiosyncratic growth. This one doesn't have it. So that's a little bit problematic. But it also is not terribly expensive. So you have, you expect to buy something quite cheaply if it's not growing, and that certainly would be the case here, right? So this thing is trading at single-digit multiples, so that's a positive. It has a decent free cash flow yield at the moment, at least, right? I mean, relative to the market capitalization of the business, which is $34 billion, you are not going to see, and now I'm not going to use that. I'd rather use the enterprise value because I think that's probably a better way to think about it. But this is still quite attractive. I mean, almost 7% free cash flow yield, although that's slated to drop. So yeah, if somebody's interested in playing in this space, that's kind of the way I would be inclined to do it. Lean a little bit long deltas, short strangle, call spread riskies, anything you can do to minimize the net premium spent. Okay. Michael Kane, do you think when the government officially opens, the market will have another rise, or most of it came today? This is seasonally a pretty good time of year. The markets are very close to their all-time highs. Some stocks, like GE Aerospace, are effectively at all-time highs. That creates a very nice wealth effect. And I think I mentioned this last week, that there have been those who've tried to model out what the wealth effect has, what the impact is on consumer spending. So the economy is 70% consumer spending. In an economy like that, how much does the rise in stock market prices impact consumers as they're thinking about getting gifts during the holiday season? And right now, at least, it seems that most are modeling in a more profound wealth effect on consumer spending than had been done historically. Is it huge? It's not a huge impact, but I think they were saying it's something like a 5% impact where they used to model 2. I don't know how much data they're using to get that and how robust that data is, but it does seem believable to me that at least amongst the more well-heeled consumers among us, that they are probably going to spend this year. And so that is otherwise supportive. So I would expect that the rally could continue through the end of the year. I don't have a crystal ball. I say it all the time. I don't know what the market's going to do tomorrow or next week, end of the month, end of the year. But I think that if we reopen and everything sort of settles down, and I sure hope it does settle down because I have a bit of travel. I'm going to be speaking in Florida first week of December. I'm then going to Chicago for a SIBO event. I have a trip scheduled for Hawaii. All of these things before the end of December, so I've got a lot of air travel. And I sure hope we have a full complement of air traffic controllers when I do that. Because I have another friend who he does an annual golf trip to Kiwa around this time of year. He was, I guess, down there last week. And their flight got canceled. They didn't know whether subsequent flights were getting canceled. These guys rented cars and they drove back to the New York City area from there, spending the night someplace along the way. So that may work if you're going from Kiwa to New York. It does not work if you're going from South Florida to San Francisco. And it certainly doesn't work if you're going from San Francisco to Hawaii. That would be quite a canoe trip. I had to do it that way. So let's hope that's not the case. Route 123. What is going on with Blackstone and KKR? This is interesting. I'm sure you guys probably know that this is an area that has been getting a lot of scrutiny lately. And the perfect situation for the folks in private equity is they use a lot of debt. Let's just say it as simply as we can. Private equity finances the purchase of companies with debt. The cost of debt has risen. And that's not good for them. KKR and Blackstone are both private equity companies, probably the two best known ones. KKR was probably better known at first. Kravis, Kohlberg, and Roberts. Books have been written about their affairs. Barbarians at the Gate, for example. F. Ross Johnson, then CEO of RJR Nabisco, when they orchestrated that takeover, that was the largest in history at that time. That was when Lehman was actually still Shearson Lehman, and my understanding is that F. Ross Johnson was using Shearson Lehman as his bankers, and he was trying to come up with a competing bid himself. It was quite extraordinary. More recently, Blackstone, which was founded by Steve Schwarzman and the late Pete Peterson, who one of Pete Peterson's notable accomplishments, for those who are interested, is he founded the Tax Foundation, I think it's called. They're the ones that publish let me just confirm that, the deficit clock. Is it the Tax Foundation? Or is it, let me see, or U.S. debt? Those might be two. So I've contributed money to one of these organizations, and I basically subscribe, I guess, to the other. So, yeah, the Pete Peterson Foundation, they fund the U.S. debt clock, which is usdebtclock.org. Fascinating and terrific website. Have a look at it. The thing that I think it reveals, as well as anything, is it keeps track of things like unfunded liabilities, which usually get lost. What are the unfunded liabilities? It's we discount the liabilities for things like entitlement spending, including Social Security, Medicare, Medicaid, and other promises that the government has made, and tries to estimate their costs, because the way the government does its accounting, we don't really see that the way we would in most other enterprises. And the Tax Foundation is another nonprofit organization and think tank which evaluates various implications for things like tariffs. I mean, you can get a lot of great stuff from them too. So I recommend those both. That's taxfoundation.org. I just conflated the two, but I like both of those. But Pete Peterson, the Peterson Foundation, funds the U.S. Debt clock. So, Blackstone's probably the better known of the private equity firms now, I think, than KKR. There are some other very big ones, big and prominent ones. Carlyle is certainly well known. Vista, which is not publicly traded, now based in Austin, is another substantial private equity firm. But the problem is that if you acquire things and you depend on cheap debt to do it, when rates rise, that's going to be a problem. And it's a problem on a couple fronts. First of all, it just means that the cost of capital is higher, but also it means that your ability to sell these assets is significantly diminished, because typically private equity firms hold these things these funds hold these things for relatively short periods of time. These are not, like Warren Buffett and Berkshire Hathaway, where they buy a company with the intention of holding it forever and operating it. Quite the contrary. They buy these things and they expect to turn around and flip them out a few years later. But in the current rate environment, it's not possible to do that. So the other interesting thing too, and this is something that Cliff Asness, if you don't know who Cliff Asness is, he's the founder of AQR, which is a quantitative hedge fund based in Greenwich, Connecticut. PhD in math, I think. He's a University of Chicago guy, I think, going by memory here. But very smart guy, and he really takes issue with private equity, because if you take a look at the marks of the positions held by most of these private equity funds, they just look like stairs that go from the lower left to the upper right. Every quarter comes along and they mark the things up just a little bit, right? They don't behave at all like the value of any other risk asset. They're remarkably steady. And one of the things about this is that very steadiness is one of the reasons why these make such attractive investments to things like pensions and endowments, because they look at these returns based on their volatility and their drawdowns. And private equity would appear, based on how they mark their own assets, in many cases not to have any drawdowns, which is rather unusual when you say to yourself, well, wait a minute, I could compare some of these businesses to their publicly traded counterparts, which in many cases are not levered as much, that exhibit considerable volatility and considerable drawdowns. And one could logically then go a little further by saying, well, there's actually no way that these marks are entirely accurate. And what bears this out are two things. The fact that these guys have not been unwinding the positions on the schedule that they previously would. That is to say that they're holding things for longer. So apparently there's not a ready line of buyers to pick these things up at the numbers where they have them marked. The second thing that has started to happen, and some of you have almost certainly seen or heard this, is that there is an increasing number of funds that are being set up and structured specifically to take advantage of that dynamic and make alternative investments, even exchange traded products. But I've seen several of these types of announcements of late. And we could refer to these as, of a sort, vulture funds, right? Now, if there are vultures circling around all of a sudden, it stands to reason that there might be some carrion down below. And if that is true, that might impact the managers. These guys, obviously, it's a wonderful business to have been in. When you think back and say, okay, well, if you were going to go to college in 1986 and say, how do I take advantage of what's going on here in the world, because the most famous thing at that point was the junk bond business, and Michael Milken made a lot of this. We thought about the LBO guys, the corporate raiders. Well, that's essentially what we're talking about here. It just got a lot more systematic, and a lot of capital and a lot of rigor. A lot of smart people coming out of business schools went into this sort of thing. And it's obviously been a great business, but it's not as great now for some of the reasons we just described. That's what's going on here. And actually, if you take a look at, we're looking at KKR's fees, you can see that those peaked out at, in the mid-high 20s, looking like smaller numbers now. And in Blackstone's case, not the same kind of pullback, to be sure, but you can see that it's having an impact. Vista, like I said, is not publicly traded, or it wasn't. I don't think they are publicly traded. No, we've got Vista Energy, but so yeah, we don't have anything there, but that's really the reason. It's the business itself is in some distress. Okay. Lyft broke its 52-week high today following their quarterly earnings release last week. Unstoppable. Considering a March 25-28 vertical call spread, but seems expensive, what's the best method to find the right strikes and maximize your probability of profit? So, one of the things you are going to find, and you have found, is that buying call spreads often will seem expensive, and the reason for this is partially because of skew. That is the tendency for out-of-the-money puts and at-the-money options frequently to have higher implied volatilities than out-of-the-money calls enjoy. And this is the reason why a lot of times when you're looking at similar moneyness put spreads, you might find yourself getting a 3-to-1 payoff. That is to say, spending 25% of the distance between the strike for a put spread of a certain moneyness away from where the stock is currently trading. And on the call side, it's closer to 40. Things like dividends and stuff which isn't normally the case, but that can play into this a little bit differently. So let's look first at the implied volatility in Lyft and see how much this managed to come in post-result. So they reported, as you said last week on the 5th, stock was up 6%. It's up again today, quite a lot actually. Implied volatility. Let's just look at the options that are expiring prior to the next earnings release, which will be the 1-month options and also the 2-month options. That's this. So they're not cheap. You're right about that. So the 2-month options are around 52.5 fall, and the 1 months are about 55. And let's see just how volatile the stock is generally outside of its regular earnings releases. I'm going to get rid of these. So that's still a little rich, maybe, but not hugely so. We have to kind of take this little blip out because we know that the quarterly earnings release came out and the stock responded quite strongly to that. So it's going to be a little bit overstated for those reasons. So you definitely want to spread this. Let's take a look now at skew, because that was the dynamic I was just talking about. Let's go out to January 1st. Actually, I don't know if I want to go. Yeah, January's fine. We'll go to January regular way. So that's going to be these options. I'm going to get rid of this. Actually, that's not so bad. If you're a buyer of call spreads around 100, you're going to be selling like the 105s or 110s. There's quite a smile, actually. That's almost a perfect smile, not so much a smirk. Oftentimes what you'll see is something that looks more like this. Right? So the call spreads shouldn't actually be that bad in here, I wouldn't think. And let's confirm that by having a look at some. So we've got this in here. We'll go out to January. We're going to modify this thing. Stock's 23. If you're trying to press a bullish bet, you're going to buy something that's probably at or just out of the money. This is a $5 option. This is $1.40. $1.40 on a $5 spread. Is that right? Yep. So that's 28% of the distance between the strike. I don't think that is expensive, actually. I don't think that's that unreasonable. And by the way, what I'm thinking about is how expensive is this call spread as a function of the distance between the strikes, not just on an absolute basis. $1.40 on a $23 stock, it's not like that's an inconsequential amount of money, right? So here, what you could do then is one of the call spread riskies. That might be a way to try to get that down a little bit. I might bump this up a little, like so. Get you something like this. And, you know, in this instance, being short the 20s, I don't know if you can see this line. Maybe I'll blow this up a little bit. So that means that your downside risk is that you get the stock right in and around here, which is essentially where it was, or even slightly lower on average than before the results came out. So that would probably be a way to play it. But I actually think that the skew is not bad for call spreads. Okay. Hi, Mike. What is your opinion on the airlines? Do you think Q4 will come in soft due to the shutdown? It does seem like it's had some impact. We know there have been some cancellations. I also suspect that there have been some folks that might have thought that they would travel and decided not to because of it. And I find myself, you know, I'm only speaking from my personal experience, but it definitely occurred to me. I was thinking, okay, well, in a couple of weeks I'm going to Florida, and then a week or so after that I'm going to Chicago, and then 2 weeks after that I'm going to Hawaii. And I was thinking, boy, could I? And I actually had some people call me up and ask me to go to New York this week. There's an event, the Seeking Alpha Conference, which I was invited to go to. I just thought, do I really want to contend with this? The short answer is no, not really. So there have to be some people, business travelers like myself, who are saying to themselves, you know what? Maybe you can wait. Let me just wait until they restart. Wait until we're back up to 100% on air traffic control. Why not? Do I really want to, at this time of year, as we're approaching Thanksgiving, and particularly for the period between Thanksgiving and Christmas, a lot of travel going on. Do I really want to start booking travel if there's going to be known pressures on top of a period where you already have plenty of problems? There's going to winter travel gets delayed because of snowstorms. It's the holidays, and then you throw in the air traffic controllers. It seems hard for me to imagine that the planes are flying as full as they might have otherwise. But time will tell. I would not be surprised to see that it did have an impact. I would expect that it had some. Huge? No, but I think there's going to be some impact. One thing about that, though, which I think is worth paying attention to, which is that if you're saying to yourself, okay, well, I want to short Delta, I want to short United because I think that they're going to come in light on their numbers. The reason I would encourage people to be a little bit cautious about doing something like that is because this is, in theory, temporary, right? So investors don't typically penalize companies too severely for something that they view to be a temporary setback, particularly if some of that temporary setback might actually result in a bump in business down the road as travel ends up not being completely canceled, but perhaps postponed. So do I expect it to come in lighter than it would have been expected to be before all of this? Yes, I do. Do I expect it to have a profound impact on the share prices? No, I don't, because I think that investors will probably look beyond that a little bit. Which, incidentally, relates to so we seek clarity, 2961, building on the question above, how would you play the airlines into year end? I do like Delta of these. So this is kind of interesting. I was looking at Delta and United back and forth. So while I did like Delta better, at one point United got considerably cheaper. And then it sort of narrowed that gap, and so then I went back to liking Delta better again. So there's a relative value, and I think what we should probably do is just quickly see where these two are with respect to one another before we make that final determination. Because like I said, I think Delta's the best operator, but United at one point was trading at like a 25 or 30% discount. This is a while back, but it was trading at a discount. So what do we have here? It is trading at a discount, but is it really a huge one? On a forward earnings basis, 8.5%. Enterprise value to EBIT, it's about a push. Yeah, I don't know. Yeah, I think I would probably just stick with Delta in here if I was going to choose one of these on the long side. Unless you start getting into that neighborhood where we were previously. There was just that huge discount that United was enjoying at 1.25%, I think was the number when I looked at it. And I actually did make a bet on United at the time, just thinking that it was going to narrow the gap. So, yeah, that's probably the way I would look at it. I don't think paying 8 times forward for Delta versus 7.6, it's not a big enough difference to make not enough of a difference to make a difference. How about that? So just go with the best of breed, and you'll probably be good. Okay, so I have chewed up over an hour at this point. I'm going to quickly scan to see if I missed anything really important. And Matt McDonald, thank you for chiming in and contributing your thoughts as a pilot. One of the things I always appreciate is getting insights from people who have more information than I do about circumstances that I'm looking at and that are of interest to me. Tucker D. Dog added, just going back to that, many theorize shrapnel from the first failure took out the other engine. Yep. And like I said, there was evidence of a compressor stall. That there was that characteristic pop, 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 little poofs of flame coming out of the engine in the vertical stabilizer, and possibly because we couldn't really see it as well, the right engine. Quite tragic, of course, but hopefully they get to the bottom of it. I always feel like every single time something like this happens, air travel ultimately becomes safer. And the other thing is that occurred to me too was, does this end up becoming a positive in the long run for Boeing as they look to replace these planes? Possibly with, these are bigger than 767s, so I'm imagining that they'll probably go to the 777Fs or something like that to replace them. And if they did, that would ultimately be, I would assume, a positive for Boeing to get a few additional orders for that plane. Okay, well, thank you all very much, as always, for tuning in, for your questions, for your insightful comments. I always enjoy those. And I hope you found this conversation helpful. Like, subscribe, tell your friends, and put your questions in the comment section, as always, and we'll see you here next time. In this case, that's going to be Wednesday, 4:15, and hopefully we'll have office hours with Professor Mark Guthner tomorrow as well. See you soon.